So we're recording this interview on Tuesday, October 24th, 2023. You've had a lot of great macro calls the last 3 years. You were a bond bear before a lot of other people. You were warning people about a VIX spike towards the bottom. Unfortunately, unfortunately, Christopher Cole of Artemis Capital, his fund didn't make it this far. A lot of institutional money and pension funds pulled out. What do you think are the biggest risks right now to asset markets and the real economy?
Oh, well, we have had a little ways while we have been avoiding recession or pulling recession risk forward in large part because of wage inflation. So inflation has been more than sticky. It's entrenched, in my humble opinion. And I felt very strongly that we would have that backdrop in summer of 2020. Basically had this whole things over paper mantra that I've been sticking with, and oil as an inflation hedge. And anyway, it turned into a very, very viable theme of basic math, that we were just not going to go down anymore in interest rates. And this infusion of both fiscal stimulus and monetary easing was going to create outsized inflation. It was going to stick around for a little while. And although wages are delayed, that was my premise, is that basically wage inflation ended with COVID. Wage deflation ended with COVID, and that wage inflation would be the enemy also of bonds. So I started out with a very strong thesis in August of 2020 that basically said, quote, bonds are done going up. And I had some strong intermarket analysis to support that. And then we kind of moved along that little curve of figuring it out. Yep, there was lots of money in the system, and definitely things were expensive. Everyone talked about supply chain issues, but it was much more. And I knew wage inflation would be lagging. We finally got to a point where I wrote a big thesis on it in October of 2021, and that bonds would basically crash, would continue to fall, even though they had already from that high of 2020, 1 year later. And so I basically said 2022, we're going to surprise. We're going to have a 20% pull down in SPY, and bonds will crash with it. And that whole thesis was on wage inflation outrunning productivity. And basically, inflation was staying sticky, and all of that happened. So bonds continued. And then this year, I didn't know where SPY would end up, honestly, for my 2023 prediction. I actually said not really great risk reward, or I said, unattractive risk reward to make a bet for year end of 2023. But I said that bonds would continue lower, and I got a lot of pushback. No way. Bonds have never, US Treasuries have never produced negative returns 3 years in a row. And I said, well, that's what I see in my analysis. I'm sticking with it. And sure enough, I think we're going to see that very clearly by the end of the year, that we're going to have negative in returns for 3 years. So it's been my baseline bet, and it's working. And I'm sticking with it.
So you think that this So you think that this bond bear market can continue for at least 6 to 12 more months?
I don't think it's done for a long time. So let's unpack this.
Oh boy, that would be bad.
Let's unpack this. So it's funny, I've seen articles that come out. All of a sudden, U.S. Treasury dump, is seen as, the 50% drawdown that we've had is a market mystery. No, it's not. Not if you came in with this thesis that interest rates were done going down, bonds were done going up, and then you and me kept checking, test. Has anything changed? Has anything changed? Has anything changed? 3 years now, nothing has changed. In fact, it's only gotten worse. War is inflationary. War is expensive. We're going to continue to have rising fiscal deficits. And this is a major reason for the season. But more than that, we also have rising inflation that is sticky. Expectations are staying firm. Wages, yes, we will at some point turn where this recession risk gets pulled forward because of jobless claims rising and unemployment rate rising, but we're still not there yet. It has helped delay the recession. We have tons of spending, which is triggering rising nominal GDP, but nominal GDP is government spending. If you strip that out, we're flat. We have PMIs in like the 50 area. That's not expansion. It's just flat. So we don't really have a growth engine. We have, unfortunately, massive Treasury issuance, which is putting a bid in that whole risk premium for yields, very much the reason for the season, even before the Middle East war headlines hit. We've got foreign central banks selling. People are freaked out about that, but they've been doing it under the cover. And that's not the biggest area of concern, honestly, at least not mine. Buyers demanding higher yields to compensate for rising U.S. deficits, recession risks, and now war is the reason for the season. And that's not going away.
Yeah, I see a really bad supply demand mismatch for US Treasuries. I mean, the retail investor is buying a lot of US Treasuries. I see a lot of people posting out, I'm buying 1 month Treasuries, 90-day Treasuries. Okay, that's great. Retail investors are getting some yield for the first time in a long time on their checking account, but then that's putting pressure on the regional banks for their cost of capital. So retail investors, good. That's bad for regional banks. It's also bad that the foreigners, they were the largest sources, China, Japan, Germany, those were the largest buyers of US Treasuries for 20 or 30 years. And they're not buying now.
But it's not just the short duration. The money that's rotated into T-bills and money market funds is really that paid to wait mantra that I had literally in September of 2022. So I had already seen that the transition going of money out of banks and into T-bills was firmly in play, and it was only going to increase. So long story short, it's still a thing. You can still get paid to wait. Right? But I'm talking longer duration bonds are still not attractive unless we get a panic. So literally, bond bulls are now betting on a panic, whether it be war or recession risk. And I'm like, why? Why would you put that kind of bet that the bottom is in because of a panic? Now, great, in time, trend reversals, we know with stocks, they can absolutely start on short covering, right? We don't have any short covering yet. We have a Bill Ackman, tweet Monday morning that he was covering his bond short. Maybe because, right? Maybe he's early. Maybe because he knows that Treasury issuance report is coming out October 31st. Maybe, Yellen doesn't dump a whole bunch on the market like she did on July 31st, which caused a literal dump in equities the day after. Maybe she puts it off to the end of the year, but it's coming, whether October 31st or 3 months later, it's coming. So the point is, we still have the baseline bet, which is fiscal debt is increasing. That translates to increasing Treasury issuance. That translates to increasing rising risk premium. Our yields are moving higher, right? That translates to Treasury and credit and equity volatility. We haven't had a real proper equity sell-off. We haven't had recession pulled forward. Both of those things are in the making. We're just waiting for a trigger.
I think actually that's the best explanation the last minute or two I've heard out of any of the macro experts I've interviewed in the last 6 months.
Aw, thank you. To me, it's just, it's logical progression. There's going to be more volatility. We're not allowed to, by the way. VIX is perfectly manipulated and suppressed with all kinds of reasons, but it's going to be a situation now where everyone is questioning the lawyering the trade, bullish and bearish. Why be bullish? What's going to really get us, back into the market, out of those money markets, the cash on the sidelines, et cetera? What would be the reason? Like, what do you have for a bullish bent for your reason to invest in stocks when you know that the Magnificent Seven are the only plays in the market that have held up the returns for all of 2023? If you would just extract those seven, you'd have zero for SPY 493 stocks, and you'd have a negative return for the Russell. Right. I mean, the point is, what would
for risk? You're talking about why would people go risk on then?
Yes. My question to you is why would folks come out of the safety of paid to wait and go into the market when the risks are only increasing, not just geopolitically, but also with recession? Curious.
Yeah, well, we're seeing a lot of red flags too. So there's the bond yields, there's the yield curve that it was inverted for over 220 days, and now it's uninverted. So that's another warning sign that recession is closer now, because that's almost a perfect indicator. You have the dollar index that's rallied, that's up to 106.23. The VIX has spiked. Gold and oil have both spiked recently together. So those are all red flags.
Correct. But That's what we're talking about. So basically, just because, we've got bonds down 50% and we can get some back and fill around here, we can get some panic buying. We still have Treasury issuance to deal with, continued quantitative tightening. The Fed is still running off balance sheet. And of course, this war only complicates matters. And recession, by the way, is also expensive and fiscal deficits be damned. We really have only a few tools left in the toolbox for the Fed, Treasury, and even White House to keep things copacetic. In other words, going along. And one is dollar swaps. Very, very popular tool the Treasury uses with friendlies, meaning like, central banks, Bank of Japan.
Yeah,
exactly. That can very much help with the stay of execution with any solid selling in equities. Because as we all know, if the dollar softens or falls, equities get bid up, right? So that headwind is removed. So that's one tool that they have used, but unfortunately, they always have to go backwards. In other words, the dollar swaps have to come back around, and then that puts more pressure. That liquidity, if you will, is drained back out. So that's one thing that they have. They could announce, QT will slow. I don't think they want to do that. They've said they're not going to do that. They could do a cut, not until probably Q1, or more importantly, not until they get an equity sell-off of size below 3,800. That's my baseline bet. And I put that actually out there in July. So on March 12th, when the announcement came around 6:00 futures on a Sunday evening, right after the Silicon Valley Bank and all that drama that transpired the week before, Fed, Treasury, and White House basically said, we're going to backstop banks. They didn't call it a bailout. They said, we're going to put this special kind of purpose vehicle together, the BTFP, and we're going to make sure that all of those unrealized Treasury losses are at par. Don't worry about it. It was one of those deals where they didn't want any bank runs, and so they backstopped the banks. Okay, market stabilized and then continued higher in March. We know what happened. It was good for equities, no question about it. Even gold liked it. Gold loves loose monetary policy. So now fast forward, that's all diminishing returns. Just like the September, October lows that we had in the market was massive central bank intervention globally. It wasn't just Fed and Treasury. It was also Bank of Japan. It was Bank of China. So there was a lot going on, and that's when we basically have intervention come into the market through liquidity infusion. So we do have some tools. They've done it before. Intervention, dollar swaps. They could again at some point announce a cut, or loosening up on the screws with the QT. All of these things are very evident, though. We now know what to look for, right? And before, we've had the bank bailout. Right now, we don't have a bank bail. We don't have any bailout going on. And equities are soft for a reason. And before we had, this backstop that was the Fed put. And now the Fed is saying, we're not really looking at cutting. We're going to either pause or hike. And the market hasn't really priced that in. So I do think the risks to equities are clear, and the market just doesn't see it yet.
Well, also, I think the other thing here is, besides the dollar rally and how the Fed is basically nuking a lot of the older U.S. Treasury bonds, the collateral in the global financial system and the banking system, I think a lot of other countries are already in recession. So there's an argument to be made that the U.S. is not in a recession, that part of the economy is bifurcated. So a lot of people who don't have high interest debt, they have a lot of assets, they're doing okay to great still. People who do not have a lot of assets, have high interest rate debt, they're not doing great right now. But I would argue that a lot of other countries are either already in a recession or very close.
And it's really interesting because ECB, for example, they back in July, late July, the ECB stopped paying banks for money that are required to keep at the institution. And since then, that euro dollar carry trade has fallen from 1.12 to 1.04, and the 10-year U.S. Treasury yield is up 30%. So that is one way that they needed to go in there and try and stem the rate of change in inflation by basically erasing $6 billion in annual income from their European banks. In other words, banks had reaped the windfall profits from when the ECB had started raising rates, and then ECB said, okay, stop that. So the funny thing is that we are absolutely looking at other economies, right, that are doing their own form of stimulus or the reverse, contraction, tightening, excuse me. And we haven't done that here. Like the Fed is still paying banks to park their money. So knock that off. Let's see if we get some real price discovery. That would be another way to really see what happens with that policy removed. But they're not talking about that either, because that would be equity volatility inducing.
Well, European Central Bank also ran negative interest rate policy for years. So that was a lot of corporations, a lot of governments were funding debt at artificially cheap rates. So when they do raise rates, then all that older existing debt that becomes even more onerous. You add in a dollar rally, that's a double or triple whammy there against another currency.
Which is why they really will try and keep the dollar, in check. So 10-year is a big deal. So I have actually a level on my 10-year that I called last year. And literally in September of 2022, I said last year in September of 2022 that we would see 4.7% by the end of 2023. And that if we stayed above 4.7% in the US 10-year, that would cause a potential 20% equity sell-off. So that was from my intermarket analysis, by the way. It's just a level that basically says EM stress, headwind to tech. In the meantime, lots and lots under the surface has already been selling off. Small, medium-sized companies are having a terrible time in this higher rate regime. So bankruptcies are up and, the whole thing. But it's also just a situation of zombies waiting for the economy to soften so that when lots of folks start announcing layoffs, they can run for cover and do the same. They're basically in a tight spot. I think 2024 is going to be a really tough time to roll over their 5-year term loans that they basically refinance at the bottom of COVID, et cetera, et cetera. So we're going to see, what I see already is a lot of weakness in a lot of small caps that have been staying alive, right, for lack of a better word, because of ZIRP and this incredible money flow from speculative investments and basically lots and lots of stimulus. So that's going to start to come out of the system, I think, starting next year. And that's going to start to pull forward the recession risk. And then we're going to have an equity backdrop that looks very, very unstable. So underneath the surface, I see a lot of breadth destruction because the 10-year is above that 4.7. Now, can they come and can they introduce something and bring that down? Some intervention, some, dollar swap, some twist in their QT, some Bank of Japan surprise, right? Whatever. Yes, they absolutely can. And they can bring the 10-year down and then that with a dollar, and that gives a stay of execution for equities for another quarter. But all they're doing is kind of pushing this out. We still don't have a real solid backdrop in economic growth. What we do have is very strong wages, and we have a very strong fiscal, impetus to go up, not down. And until that changes, I think the gig is up. We're just kind of biding our time.
Yeah, I agree. I think the policymakers are not perfect with their timing and stuff. So normally they're reactive. So normally there's going to be a lot more pain. I think the pain is looking like it's going to be these banks outside the United States that are sitting on these older U.S. Treasuries. You mentioned the 10-year U.S. Treasury bond. The average person doesn't understand how much of the global banking system and global financial system those 10-year treasuries make up as collateral, not just in the euro dollar. There's a lot of foreign banks that when they have profits or liquidity, they park it in treasuries. So if the Fed is raising rates and you're a bank and you're outside the United States and your currency is getting killed against the dollar is rallying, and you own a lot of these older US treasuries, you have massive losses on those bonds.
That's why I say the dollar is key. It's absolutely key. So the budget deficit, trade imbalances, they're almost all entirely due to reserve currency status by the US, right? So if we actually lose a little bit of that, it will help to solve some of these problems, meaning that when we start to balance trade, we will have more tax revenues that will force kind of local production and local consumption and local taxing. So the reserve currency is a bit of the problem. And that is going to, I think, believe it or not, what everyone's worried about is going to be the saving grace of sorts, where when we see some US dollar weakness, which I think is going to be orchestrated, because we can't have a spiking higher dollar. That would freak out equities very, very quickly, right?
Global margin call, I call it.
Exactly. So we can't have that. So they're going to try and keep that contained. But the long and the short of it is when we start to see US dollar weakness, it can be a benefit to reshoring competitiveness, in some of the US trade, imbalances. It can help with US tax receipts. It can help the game get played a little bit longer, right? So it can help, especially companies. And again, I know you're saying recession abroad, maybe China slowed down, but the point is, it's still better to have a softer dollar than a strong one if we're in this spot where we need to compete and consume and pay taxes. And it also helps lower the risk premium demanded by bondholders if the falling dollar helps to stabilize yields. So I really think the only mechanism that they have at this point, besides a big debt jubilee, which people talk about for clickbait, is to manipulate the dollar lower.
I've had conversations with Canadian bankers. I mean, things are dire there with home equity loans, home prices falling, credit card debt, their economy with the inflation, and they have a lot of exposure to the dollar rallying. So, I mean, it's just, if it's that bad in Canada, I'm sure it's that bad in a lot of other countries too. So I don't know if they're technically in recession, but their banking system, the collateral, the home prices falling, the consumer debt with high interest rates, credit cards, home equity loans, it looks like it's going to hit other countries first and then come here to the US.
Yeah, I don't know about the sequence of turns and who gets hurt first. I just have eyes on US economy and stock market, honestly, and the reason for laser focus on dollar and yields, and also oil, because energy, we're sufficient here as it relates to oil. We export our spare capacity, and that helps keep the kind of global pricing set. But the bigger issue for me is the rate of change that has occurred in longer dated yields, right? So we know that the Fed has control of the short end and the long end. They also influence, but the point is there's no lack of stickiness and strength in the long end. So they're okay with that right now because it also inflation helps deflate the debt to a degree. But there is that stimulus effect that I think they're counting on. In other words, that money that's earning interest, right? And lots of companies, by the way, are benefiting from that, who have a strong balance sheet, right? So they have lots of cash that's earning interest. It's helping to offset some of the liabilities. So think energy companies and big tech. So that's one of the reasons why they have stayed the Mag 7, and the energy companies have kind of outperformed every other sector. Do you know every other sector is in a bear market? Every other sector is down more than 20%. So we have this bifurcated market where it's the Mag 7 and then energy companies.
and uranium. Yeah, we've had a nice uranium rally.
Well, we've got sectors within energy that are hot fire flames, right? Like uranium. But I mean, within that space, why are those two the strongest? They got a lot of cash flow. They got tons of cash flow. And
also lack of investment on the supply side for years. So you had all these stupid ESG policies, and then the market, there was a surprise on demand outside the United States. So demand was actually strong globally, and then there was lack of supply. So there was earlier this year, 6 or 7 months ago, there was record net short oil futures contracts. I mean, as a contrarian, that very much interested me to look on the other side of that trade.
Well, I'm, separate from oil, because oil has this kind of speculative fury that comes in when we have weather or fires or conflict. But then that risk premium typically is deflated like a balloon, literally. And that's because supply disruptions do not trump demand destruction. And one of the reasons why I am, not wanting to outright short oil on conflict, or gold for that matter, but their underlying plays, I'm really comfortable in doing that, because it typically means there's going to be a reversal. The air comes out of it. So long story short, I don't think that oil right now is a concern until crude can get and stay above 95. 95 down to 65 is basically this big range, big range. And we've chopped about there for a solid year and a half. The risk comes if we can get and stay above 95, then we have a whole new ballgame, because obviously there are lots of countries that are completely dependent on energy imports, and that cost structure is very, very currency devaluating. So right now, that's one of the ways that they kind of offset, right, that expense. For us, we have we're ring fenced, as you know, to use your term. So I'm just looking at the fact that we really just have the strongest companies with the biggest moat and balance sheets that are earning cash and can invest those cash or cash equivalents into these, strong, high yielding instruments, are making the market seem like it's a lot safer. That's my contention. And then with the dollar, let's see if the government does come in and kind of tries to control that, because that's the best means that they have to keep the party going. 10-year yield at 4.7 obviously hit. We overshot it to 5%. So now I have to move my critical line in the sand up. It's now 4.9. 4.9 is really critical. If we stay above 4.9 on a weekly time frame, in other words, we kind of churn around here. I'm not talking about the intraday, right? I'm talking about solid stay of support above 4.7, becomes 4.9, becomes 5.1, becomes 5.3. We're going to keep marching higher. What's the alternative right now to tap it down? Basically the dollar. And if we can get oil down too. And sure enough, the administration is out with all of the usual headlines. They're talking to Venezuela. Softening sanctions in Venezuela. They only bring that out, by the way, when oil's gotten too high.
They can't dump any more strategic petroleum reserve, right? We're already 50% or lower. So
exactly. So that's, they come in and they start talking about Venezuela. They start announcing, Biden's talking to the Saudi prince and, this and that and the other thing, all with the ambition of basically keeping oil what my colleague calls an intervention collar. And it's a beautiful name for it because I can see it. I can see it on the chart. 95 to 65. They don't want it to get above there. That's all there's to say about that. And they've done a really good job, by the way, of making sure it stays within despite war.
Well, there was a lot of oil bears that were shorting oil that thought it would go below 65, but that number 65, it's right at the production cost amount. So if it goes below there, you're going to see a lot of oil production, a lot of supply come offline. It's just not economic anymore for deep water. It's not economic to spend a lot of capex to drill those shale oil wells that are super costly now. So it makes sense that 65 would be kind of the number right now. And we're going to see production costs go up, unfortunately, in the future.
Well, the cost of capital has gone up for sure, and labor. And so I can't disagree with that. But I don't think it's as dramatic. So my point is we still have spare capacity, or we wouldn't be exporting it. So it's not so black and white. There's a lot of nuance to being a bull or a bear. But there's also the lawyering of a trade, being able to see both sides. So I can see the bond bear side very clearly, and I check it every single day. Has anything changed? The value of collateral has gone down. Equities don't realize that. Okay, they haven't really priced that in. Okay, maybe sometime they will. But for right now, there are also lots of mechanisms to keep equities lit, meaning that concentration risk into the mega cap tech Magnificent Seven. I understand weighting within SPY and NASDAQ 100. So the point is, there's a lot of nuance around what makes stuff work. And that doesn't even talk about the options market. Like literally the structure, I'm options trader, but more importantly, I'm interested in how the gamma levels influence automatic buying and selling, like the price insensitive buying and selling. So I'm tracking macro. I'm doing my intermarket analysis. I'm doing my technical. I'm doing my fundamental. I'm doing the quant, also sentiment. All of this basically shake it up, like roll the dice. What's it say today? The point is they have a lot of narrative out there that can't be trusted. You've got to question everything. Everything. One siloed approach to thinking to be a really solid market analyst is so limiting. And if it's easy, I get it. But then you might as well just invest in a passive ETF and do no thinking. So this to me is much, much more nuanced. What's happening in the economic background right now is bifurcated as well. As it relates to, we do have pockets of great concern. In other words, all the sentiment surveys that come out, they're very, very concerned about inflation. They're very concerned about, keeping the company up and running. The cost of capital, not just the materials and labor costs have risen, but how to squeeze out, higher prices and margins on smaller volume. So they've done a lot of creative thinking here, and they'll come up with another idea next year, to kind of keep it going.
Well,
but
what the restaurants do
the cost of capital is going to do in a lot of companies. The cost of capital is going to do in a lot of companies.
Oh, I agree. Yeah. But what restaurants are doing, for example, is shrinkflation and substitution. So the portion size is dropping to maintain profit margins. So they're dealing with all the higher input costs, the higher cost of capital and wage price spiral, what you said, higher energy costs, all those things, business insurance. But what they're doing is substitution. They're reducing quality ingredients for lower quality, or they're just reducing portion size with shrinkflation.
Yeah. And that's pretty typical that you see before you come into that next wave of it's still not working, right? Now we're going to have to lay people off. We haven't had big layoffs. We have not had the unemployment rate move even to 4%. We have only moved up 0.4% from the low. But there is a very famous SAHM rule, SAHM, named after Claudia Sahm, an economist, who basically showed with 100% perfect track record that anytime you come off a trough and move up 0.5%, you trigger recession, even if the market doesn't know it yet. We're at 0.4%. All we need is one non-farm payroll report in November, which happens to be the 3rd, or December, which I forget the date, but it's, beginning of the month, to tick up. And I think that's also going to induce volatility because that is a high hit rate. That's a really good kind of line in the sand that we have not hit, right? Since the COVID lockdowns, we have not hit. We're getting really close.
Well, the yield curve also uninverted too. That's another red flag. But so if I were to describe what you've said over the last couple of minutes, you're mostly, as of right now, risk off. But in terms of like bullish on things, you're bullish on big tech and energy for now, but that can change based on certain factors.
So that's simplistic. I got to break that down. What I do for clients, because I run a live trading room, I engage with them and I find out what their interest. First of all, of course, I share my market views and sector rotation and calls for volatility. And I have 3 portfolios: a trend, a swing, and chase. Chases are, a few days, and swings can be a few weeks to a few months. Trends are a few months to a few years. So that depends on everyone's definition of time frame. But those are mine. So I have investors who are active versus traders who are active, right? I have retail and I have institutional. So I'm serving all those masters. The point is, what I have, if you say, what's your view of the market for tomorrow versus end of year versus next year, it's going to change. And I'm also going to change with the information. So if we do get some type of economic data that proves to be expansionary, like not the nominal GDP, which is full of government spending, it's a fluff figure, but real expansion in PMIs, real expansion in GDIs, right? Real expansion in real GDP, then I'm going to get more bullish. In the meantime, that's just an economic view. Then there's, sector rotation that you were just talking about. I am expecting a growth to value rotation that hasn't come, right? We've already had
so like the traditional, are you talking like traditional defensive plays? So like utilities, consumer staples? Because I know a lot of people went, 12 months ago, they started going into treasuries, utilities, consumer staples. Those trades have gotten wrecked the last 12 or so months.
Yeah, that's also not how I think ever. So what I just said earlier, which was that we have had, believe it or not, I know it's hard to believe, but this year to date, percentage of stocks in a bear market by sector, the only one that is not in a bear market is energy and the Magnificent Seven. And by the way, Tesla missed, so they're out. It's now the Magnificent Five. And then Google reported after hours and they beat, but the reaction was very aggressive. So now it's down to 4. So Microsoft did fine. But the point is, real estate is down 68% as a sector. Consumer discretionary, 55%. Healthcare down 55%. Consumer staples, 54%. Materials, 52%. Financials, 51%. I'm talking about percentage of stocks in a bear market by sector. What is there to be bullish about? So there's no sector rotation. What we have is concentration risk in mega cap tech 7, period. And then we have some energy that's holding out because they're rich. And I love the Buffett quote. Warren Buffett said, I may not become super rich by owning energy, but I will stay super rich. So energy is only down 4%, at least when this, sector rotation view was taken. That's not a bear market. It's the only one that's not in a bear market. Technology as a whole is down 31%. Under the surface of the concentration risk of NVIDIA and Amazon and Google and the rest, you've got destruction across the board. We had forced selling in those staples. We had forced selling in utilities. That's also part and parcel for higher financing costs. This is a big deal. Anything above 4.7 is very much risk off. So I actually had a line in the sand that was 4.3. Then I pushed it up to 4.7. Now it's 4.9. And the more that we rise in that 10-year, dollar staying stable relatively, the more sectors sell off. And I'm now short energy since last week because I think that's next. What's left? Mega cap tech. I'm also short that. So the point is there isn't anything left except Bitcoin. Sorry, but that's not a safe haven for me. Nope. The gold's probably going to be the last one, but it's paper market, which is very frustrating.
Well, we were discussing Bitcoin, I think, on Twitter a couple hours ago. I think there's like a lot of it's used as an intermediary to get savings out of China. So it's not buy and hold by the affluent Chinese person or Chinese elite. They're using it as an intermediary to get around the capital controls because I think they are worried about a yuan devaluation. We're hearing about bank bailouts, real estate problems, and other real estate developers close to failing. I think the largest one in China is Country Garden. That one just almost failed on their dollar bonds a week ago. So there's a lot of money trying to leave China too.
Yeah, that's actually a brilliant point and something I had not thought about. So you're saying that this is capital flow out of China using crypto because it's unregulated. Even though China tried to shut it down a few years back, it just created a massive underworld or black market or gray market, whatever you want to call it. And I do, follow this as it relates to NVIDIA and such. But basically, this is money laundering.
Well, the rules, unfortunately, there's Chinese people are not free and there's not a lot of investment options for a middle-class Chinese person. So they don't have a lot of stocks. They don't have a lot of ability to diversify out of China to get their capital out and diversify into other currencies or foreign stocks. So over the years, a lot of Chinese are overexposed to real estate inside China. They're overexposed to Chinese banks and saving in yuan. So if there is a yuan devaluation, and you're seeing this now too, Chinese gold demand, there's been a lot of physical demand. So the investment options for someone in mainland China because of the capital controls, unless you're politically connected, a Chinese Communist Party member or a billionaire with connections, it's really tough to get a lot of your savings out of China without paying a money laundering fee or using Bitcoin. So the demand for physical gold is strong. Bitcoin's also used, like I said, as an intermediary to get your savings out of China.
I think it makes sense. I mean, I get it because to me, Bitcoin is really more of an off-ramp of liquidity in the US equity market to avoid volatility. So I always see Bitcoin spike right before we should have a major VIX spike. It's fascinating. I've watched this parallel and it's lost its beta with NASDAQ performance. It was really, really strong for a while, but not anymore. But when it spikes, it's very much, for me anyway, kind of a barometer of volatility suppression.
Well, there's massive amounts of dollar denominated debt inside China that's connected to high real estate prices. That was their collateral. So there's big issues with this dollar super spike. If the dollar index, if it does go higher, I mean, there's going to be defaults on that dollar denominated debt in China and in a lot of other countries. So people are starting to worry about that for sure.
Interesting. Yep. No, you have some good insights there. Thank you.
I have good contacts in China. I actually know the plant manager who opened up the General Motors plant, and Kyle Bass and Emma Molman, some of the other hedge fund people. So I built up and also a Chinese banker who retired. I do get information from them. So I have some pretty good contacts there over the years that I've developed. I want to get your thoughts though on NVIDIA. So you were actually the first. I've seen all these ripoff videos all over the internet with CoreWeave and Magnetar Capital. You were the first person to actually do the research on NVIDIA and the red flags. Are are there other companies that are doing anything this crazy? And are things still this crazy with NVIDIA?
See, I didn't plan to find NVIDIA, let alone look into anything else. I'm not a forensic accountant. I honestly kind of like stumbled on this because I have a skeptical mind. I absolutely do not understand how I shouldn't say I don't understand. I am one who absolutely looks at the outliers, okay, because I believe they revert with velocity and tracking NVIDIA up. Oh my goodness. What is it? It's 60% per year, right? CAGR. It's up 1,000% in 10 years, literally, right? I'm talking about just literal return on that over 10 years has been an outperformer of it's outshines Apple, Amazon, Google, all of the rest by a nautical mile. And so all I did was look at it and say, what's up? This seems priced for perfection. And I literally did a video and, it was basically middle of July. And I just said, I think the market's really just kind of like priced for perfection. But this one in particular is way, way overdone. And everybody is long. I understand it's on every balance, every portfolio.
Is it trend traders that are just going long though? Are people actually buying it for fundamental reasons or just because of the chart and trend trading that it's up, it's going to keep going up in the short term and they don't,
I don't know the motivations. Yeah, I don't know the motivations I'm just saying the fact that it had this very strong parallel with crypto was what I started being interested in it because it was just such an outlier. That's all. So the fact that it was such a massive outlier relative to the other mega cap tech and everybody was married to it. They weren't dating, they were married to it. They were married to the thesis that this AI was not only going to rock the world, right? And their technology and their leadership and their everything was just justifying all of this valuation, which was pulling forward all kinds of demand, despite, chip export bans and Intel and Taiwan Semiconductor and all, the manufacturers themselves saying, yeah, we don't have it. So there were just too many.
They don't have what?
No, they don't have the supply, it was all very constructed of, you have to believe us, the demand is amazing, the technology is, the AI is revolutionary and it's going to come all at once. And so you have to be prepared. Everyone's freaking out. They were just feeding this frenzy of hyperbole and it just didn't smell right. It didn't pass the smell test. That was it. But then the day after earnings, and I noticed obviously the CoreWeave connection on their data center revenue. That's what really kind of tweaked my interest. Going, I don't know anything about CoreWeave, but this seems a little bit sus. And so it became a thing. It became a little viral thing because I questioned, is the end demand real? Because CoreWeave looks a little sus. And then basically it turned into videos. They were interviewing me or they were doing their own investigation. And so many people did their own investigation that was really rigorous. I loved it. I thought it was like, hadn't thought of that. It took a village. So then basically a month after all of that, drama. And I only did that one interview. I turned everything else down. You know that because you asked me. I said, I'm not going to talk about NVIDIA. This is created. It's a maelstrom. And I only wanted to be an analyst and watch it. Right. So maybe it turns.
Well, also, you probably didn't want to deal with the stuff in the mainstream financial media. I mean, the mainstream financial media is not even investigating any of this stuff. They called it all like suspect Twitter people and stuff like this.
I know. I got called a Twitter rando, but not by name, which is adorable. I know. But basically, I kind of went through and I went into a full post very, very publicly, right? Just whatever it was last month. So after everything had kind of quieted down, I literally went through the exercise of questioning CoreWeave. Okay, now that everyone's calmed down, let's kind of go through all the deals that they have just struck, right? They're trying to raise capital with a 5 to 8 billion valuation. They're doing a raise, all the, fund guys or hedge fund guys. Anyway, the point is, and they got all kinds of suspicious backgrounds, but I didn't want to go into calling anyone or anything a fraud. I basically said, I want to think about why NVIDIA would even need to do this kind of deal with a CoreWeave that has such a suspicious background and all the other players that are so suspicious. So it was basically a question of, why would they do this? Anyway, that's what my article basically focuses on. is the deal that they struck, and it's very suspicious dealings. And then going into famous kind of, we had the Valiant fraud, which basically it took 2 years before that was unveiled. And
it fooled the Bill Ackman too. It fooled some really smart hedge fund managers.
Correct. And we got everybody who's invested in NVIDIA. There's no lack of excitement over where they're going to take us with the AI hype. But anyway, I did a lot of due diligence and I put it all together in a post and I put it out there, and at least it's a marker. In other words, if this takes 2 years to unearth some suspicious goings on with either the revenue recognition or the company they keep, I wanted to just have a timestamp where I had done this work. And it, again, for my clients, I'm like,
you don't get any financial benefits from any of this.
Zero. I don't have a monetized YouTube channel, nothing. I basically saw this as a challenge of everybody else was just accepting it blindly. And I had no interest in discussing or debating the quality of the technology. Nope, that wasn't my focus. I'm not a geek in that regard. It really had to do with, NVIDIA seems so tied to Bitcoin, mining, crypto. There's just way too many other players, Magnetar and Tether, and
it should be a documentary.
It should be, but nobody's going to look into it because everybody owns it. And
I think everyone's afraid of getting sued by the large companies. Everyone's afraid of getting sued. Correct.
And they have much bigger pockets. But it really did come down to NVIDIA seemed to transition perfectly, when crypto revenues plummeted into this AI theme. And I use this example in my article, but I think it's a really good one. There's Moore's law, which is obstacle to the growth rate that no one really is talking about. But retail price of cocaine has remained very stable while the purity of the stuff has increased, right? And so that's basically the fraud that I'm referring to, that I think that
didn't expect to hear that analogy on this.
I know it. But that's exactly what I think they're kind of trying to make us believe. Moore's law asserts that the cost, right, like the GPUs, will maintain stable in nominal terms even as computing demand increases. And I use that cocaine purity to price as an example. But it's the same concept, right? The evolution of computing power costs goes down, right? So the TV that I bought 20 years ago, that was 2,000, is now 200, right? Same exact idea. And the difficulty of mining in Bitcoin is only going up. It's much harder to mine for Bitcoins now.
Well, it's meant to copy gold. Yeah. I mean, look at gold mining.
Exactly.
It's not $500 to mine an ounce of gold anymore. I don't think anyone on the planet can mine for $500 an ounce anymore.
Exactly. So NVIDIA really needed the crypto revenue, and that turned into the AI. AI hype was, for NVIDIA served like rain in a desert. And the whole concept was, okay, now I understand if desperate times call for desperate measures, they gotta go find some clients that also help them support that belief, right? That AI hype accomplices are trying to paint a picture where end demand and NVIDIA's revenue curve relationship are linear. And that's where I take issue. That's exactly where I take issue. So this is the problem. They want you to believe that AI hype is linear, the end demand is linear, revenue curve is linear. And my whole point was, I don't think so. I think that this is the top. So I put together this thought, and it kind of created its own ecosystem of people who are discussing with amongst themselves, et cetera. But I really think that it needed to just be put out there because there's too much acceptance and not enough due diligence. There's a
lot of thank you for doing this. You've done a great job with the detective work, and then other people have picked up the pace afterwards.
Well, we'll see where it goes. They absolutely have their earnings darling, and they've pulled forward demand, but they still say they have a absolutely up and to the right unmitigated linear track of lots of continued demand and revenue. We'll see. We'll see how earnings do. But again, this could be a multi-year theme that just needs to unwind slowly, then all at once. That's how most situations like this end up.
And if there is any accounting fraud found later by the Securities and Exchange Commission, they'll probably just pay a tiny little fine, a slap on the wrist. There's tons of corporate fraud and account and government fraud, and almost no one goes to prison anymore for it. I mean, at best, normally it's a fine.
Yeah, and they're all in on it, so there's really very little incentive for them not to do it. They don't even have to worry about hiding it. It's one of those deals where they've already been, found for labeling, revenue, crypto revenue. It doesn't matter. All the little, I don't get excited about the little details. It's the whole story, overarching story of this continued argument that we're just supposed to believe that the revenues and the demand are up and to the right. It doesn't make any sense for this particular space. And I will wait patiently and see what happens. But I think that's the problem, or if you will, the fraud that we're led to believe, not necessarily that they are physically committing accounting fraud or any of that. I just think that this is the picture they want to paint. And guess what? Everyone likes what they see. They don't question it.
Well, to add to your points there, you mentioned some fines. I mean, they already, I think in February 2022, they paid a fine for accounting fraud. It was over crypto. So I remember for years, NVIDIA, they were telling people that most of our revenues are not subject to Bitcoin and Ethereum prices, and crypto traders and speculators and miners going out and buying those graphics cards to mine. They were telling people this for years, and it was proven that they lied about this, that a lot of their revenues were, and they paid a fine on it, but there's no prison time or anything like that. So for me, though, this just shows that management has a track record of doing this stuff, and they just figured that, okay, we're just going to pay a fine, and the average person isn't going to question that much as long as the stock price is going up.
Honestly, I will just wait patiently. I don't think that this is anything more than making clients, this was my intention, aware that losing an illusion makes you wiser than finding the truth. I wasn't seeking the truth. I was literally trying to open eyes to no longer follow blindly when there were so many questions, especially the characters they keep. And I stand by it. I think everything I put down there was pretty reasonable, to ask. And it got a lot of flack and a lot of pushback. But the story is just starting because nobody else has asked the questions, right? So we got months, years to go before we really get any answers. But I do think it's tied to crypto in a big way. Actually.
Oh, I think it would make an excellent Netflix documentary, although there's a strike right now. So I don't think we'd see it for a couple of years, but it would make an excellent documentary, though.
Well, thanks for reading that all the way through and following it. I really appreciate it, Jason.
Well, I enjoyed our discussion today, Samantha. I definitely want to have you back on in a couple months for an update. I mean, things are changing so rapidly, especially with the rules changes. If the dollar or Treasury yield spike, I mean, we could be looking at a 20% down or worse environment, but then we could see a reversal with more rules changes or liquidity programs, bailouts, QE. What the BTFP, I would call that a shadow liquidity program. So if the Fed doesn't want to expand its balance sheet, I guess what's going to stop them from creating more shadow liquidity program? That's
the quasi-fiscal deficit that we're actually creating, where the money is now sterilized. It's now taken on to the Fed and Treasury balance sheets, which is extremely dangerous place for us to go. We obviously are not Argentina. We print our own money, but it is extremely poor returns for U.S. Treasury holders. And why? Where's the incentive for foreign countries to come back in and purchase U.S. Treasuries when we're doing that kind of monetization of debt? And it's not been done to this level. And that's why I am just more risk aware. Even if equities seemingly hold up, we've already talked about that. It is very much a game that they continue to play, but there will be bigger side effects from all this quasi-fiscal management that they're doing with the debt and the printing. It's not a good trajectory, but we know that.
I think it's not just
on that.
Unfortunately, I think it's not just the US, though. I think it's all these countries with their banks and their government bonds. There's just too much credit, too much debt. And then when the dollar rallies and the Fed raises interest rates, it starts just blowing up all the collateral in the system and all this other government debt and stuff.
No, it's 100% the point. It is definitely the concern that this is integrated, right? Where we are trying to, post-COVID, it seems, countries are trying to ring fence a lot more, bring the money home, right? Japan's doing that. China's been doing that. We're trying to, figure out our manufacturing here in the States, energy independence, or at least striking deals or alliances or regional alliances for military and currency conversion. So we have a very different world order. There's no question about that. And I'm not looking at that so far away because I'm more short-term focused on what do we do with the equities that we hold as investors and or trade. What are the triggers, bullish and bearish? What's the argument to make me want to invest in the market or invest in bonds, and when? And I use, like I said, a whole bunch of modalities of kind of figuring that out. But I don't think it's very bullish, and I would like to let this actually fall and have a little bit of price discovery so that we kind of wash some of that out and see where it lands. I think that'd be actually a pretty healthy thing to do.
Yeah, I'd like more free markets, deflation, bankruptcies. I don't know if the people in power are going to allow that with more rules changes, shadow liquidity, bailouts. But I mean, if things get worse in the Middle East and Iran either puts an export ban on oil, or Iranian oil supply either comes offline, or there's, I don't know, some type of attack and oil supply comes offline, those oil shorts, that thing could blow up and there could be a big short squeeze. So we'll see what happens.
We will see what happens. Hopefully none of that.
Well, I think you're a must follow on Twitter. So I'll attach a link to your Twitter X page and also your website, which is LaDuc Trading.
Thank you so much, Jason. I appreciate it. Have a great rest of the week.
And let's definitely have you back on plan in a couple months.
I'm around. Bye.